Hi, I'm Jared Nelson, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we are going to look at a concept that traders have a love-hate relationship with, and that concept is volatility. Price changes are the very lifeblood of the financial markets, yet markets can be quite picky about the types of price change they like to see. Markets hate uncertainty and are happiest when prices move in a regular progression or trend, whether that's up or down, because those trends create a sense of predictability or order. In contrast, volatility is chaotic and the exact opposite of those ordered trends. Volatility represents both a threat and opportunity to traders, so it's important to have a working knowledge of the concept. Volatility reflects the likelihood of a rapid price change in a financial instrument or market, and it is expressed as a percentage in a range between 0 and 100. The indicator is calculated by looking at several factors, including the history of price change in an instrument and current interest rates or risk-free returns. As a rule of thumb, we can say that the more stable an instrument's price history is, then the lower its volatility is likely to be, and vice versa. To be clear, volatility isn't concerned with individual price changes in an instrument. Instead, it looks at the rate at which prices change or vary over time in, say, the S&P 500 index. Work undertaken by economists and academics in the 1970s created a series of new equations to help analysts model the markets more accurately. These equations, known collectively as the Black and Scholes model, allowed traders to quantify volatility and helped to create the modern futures and options markets. Historical volatility could now be used to calculate the implied or likely future volatility of an instrument, though not the direction of price change. However, as we now know, heightened volatility is usually associated with sharp downward corrections in the markets. Being able to calculate implied volatility led to the creation of specific volatility indices. The most well-known of these is the VIX index, which tracks the changes in implied volatility among the S&P 500 constituents. The VIX has become known as the Greed and Fear Index, because when markets are greedy, prices tend to move in the same direction at the same time. Under these conditions, traders who are said to be bullish are more than happy to go long on the markets. However, when markets are fearful, traders are more concerned about losing money than making it, and their mood is bearish, and they are likely to sell assets to either bank profits or avoid potentially larger losses in future. Traders need to have awareness of and respect for sharp changes in volatility because they can occur unexpectedly. However, traders can use volatility to their advantage. For example, when volatility spikes, traders exhibit risk-off behavior. That is, they sell risk assets like equities. But after the correction, we see a return to lower levels of volatility. We tend to see a resumption of risk-on behavior. When traders talk about buying the dip, it's that kind of price action and reaction that they have in mind. In the chart, we can see how the VIX and the S&P 500 index performed during last year's COVID crash. We see a sharp spike in volatility coinciding with a large sell-off in the S&P. And then, as volatility corrects lower, the equity index begins to rise once more as buyers return to the market. Traders can also look to use volatility to their advantage when they are trying to decide what instruments to trade. Markets that are experiencing higher levels of volatility move around more. Larger price swings offer traders the chance to capture bigger profits on a position. But by the same token, there is a risk of larger losses when trading in a more volatile instrument. In summary, traders should be aware of the levels of volatility in the markets and the changes within them. Traders should be cautious as and when volatility spikes higher because those spikes represent periods of change and uncertainty. Traders should take less risks in periods of high volatility, though the periods after sharp downside corrections can offer trading opportunities, as and when the markets and levels of volatility settle down once more. That's all we have time for today, but please do your own due diligence before making any investment decisions. To find out more about our TrackStar IQ data, sign up to our free newsletter at investingchannel.com/TrackStar.